Hi everyone, this is Kevin Davey, and today I'm going to give you an introduction to walk-forward testing. So, what we'll be talking about today are some of the different types of testing and evaluating a trading strategy. Some you're probably familiar with, some you may not be as familiar with, and so this is kind of just an introduction to kind of get you familiar with the different types of testing out there. And then we'll talk about the pros and cons of all those different methods. You know, there is no perfect test method to evaluate a trading strategy, and so we'll talk about some of the pros and cons. And then we'll go into an example of walk-forward testing, which is my preferred way of testing a trading strategy. So, first, what are some different ways to do a historical test? Okay, well, the first one isn't even an historical test. You just go with live real money testing and trading at the same time, right? So if you look at the calendar I've laid out here, if you're starting today in 2016, everything's out of sample because it's all in the future. There's no way to over-optimize a strategy like this because you never test it. And that's the great part about it, is you know you can believe the results because those are real money results. A lot of people do this, especially discretionary traders. You know, they'll come up with an idea, maybe they'll look at a chart or two, and without evaluating it any further, they'll just launch in and start trading real money with it. Does it work? Yes, it can work, but it also can be pretty expensive. As you test method after method, that just doesn't work in real time with real money. That's the reality. But it is a method. Method 2 is an optimized test. Now, you could do this also with no optimization at all, but when most people put in some indicators or patterns or stop losses or whatever, the tendency is always to optimize those values. They'll get results and say, ooh, I can do a little bit better if I just optimize this stop loss, for example. So in that sort of scenario, all the area in blue, which would be in this case from 2007 to 2016 until yesterday, would all be considered in sample because that's what you run the test on, and if you have variables you optimize them, and then at the end of the day you look at the results and you decide whether to go forward. Then going forward you'll have the yellow because that's out of sample, right? It's after you developed it. So those are important terms to keep in mind. In sample is the data that you use to optimize and to test your rules. Out of sample is unseen data, or it's unknown data to the trading system until you actually run it with that. So as you can imagine, in sample data is pretty optimistic, and it's a lot better than you're going to see in the real world, where the out of sample results tend to be a lot more repeatable in the real world. Now, even then, sometimes what you get for out of sample results won't turn out to be that good, or you won't be as that good with real money in real time, but it's a lot closer to the the reality of the situation than in sample. Okay, method 3 is what you've probably heard of as out of sample testing. And typically what people do who do this will test a strategy over 80% of their data roughly, and then they'll confirm it works with 20%. So in this case, you can see we took a lot of data out, 2015 and most of 2016 up until yesterday. That becomes your out of sample test. So you optimize over the blue period. You take whatever parameters come out to be the best for that blue period, and then you run those on 2015 and 2016. Now that's a lot better than the first two methods because you're getting more out of sample data. And as I mentioned, out of sample data tends to reflect reality a little bit better, and sometimes a whole lot better than in sample data. So that's a pretty common one. A lot of people choose to do that. I take it a step further in my own trading and go with what I call walk-forward testing, or what is called walk-forward testing. I did not invent this. I believe Bob Pardo, who's pretty much a trading legend and money manager, he was the first person to really popularize this approach. But what you do with that is you go in a step-by-step manner. So in step one, you'd optimize your strategy over 2007 to 2011, for example. Take the best results, apply it to 2012. So this is unseen data at the time you run the test. So your optimized parameters are were done on the blue area, but you're running them then on this unseen out of sample data. So that would give you 2012 results. Then you run a next step where now you shift this window 1 year. So now you test from 2008 through 2012. That becomes your new in sample period. And you run that on 2013. And you keep going step by step until you get to the present day. And what you end up with are all these yellow periods, which you put together will give you your out of sample period. Now you might notice, if you just compare it, if you recall what the previous three charts look like, there was a limited amount of yellow, which is the out of sample. But with the walk forward, it has the most out of sample data. And that's what makes it such a valuable tool for evaluating a trading strategy. You get more out of sample data by using this approach. So let's compare. How did all these different methods stack up with some different criteria? So we're going to look at the real-time, real money testing, the optimized testing, the out-of-sample testing, and then walk-forward testing. And we're going to look at a few different things. How hard is it to run the analysis? You know, how complicated is it? Because obviously if it's way too complicated, you're not going to do it. You want something that's reasonably simple to run, right? Then there's believability. How much can you actually believe the results? That's an important characteristic. And if you use that method, how easy is it to develop strategies? You know, you don't want a great method that never gives you a good strategy, right? You know, you'd be testing for years and years, and after 10 years you'd come up with a strategy. You don't want that. The next point will be the amount of out-of-sample data that it gives you. And like I said, that's important for assessing the viability of a strategy. And then, what's the tendency of the method to work in real time? Meaning, you have certain test results. How likely is it that those test results, you know, whether it's profit per month or whatever, that it's going to continue on? Because that's what you want, right? If you're testing a strategy that and over your test period says that you will get $1,000 per month profit, you don't want to go live and it turns out it's only $100 per month profit, right? Because it's a lot worse than you'd expected. So let's look at analysis complexity first. How hard is it to run this analysis? Obviously the easiest one is real money and real-time testing. Okay? Because you don't have to do any testing. You just start running it. And if you had to guess what a lot of people do, what would it be? It would be this real-time, real money testing, because it is, in effect, no testing. They're just running. That's what most people do. But remember, Most people lose. So keep that in mind. And then as you go further on, optimized testing is fairly easy with most trading software. You just pull up a chart, insert a strategy, hit the optimize button, there you go. That's pretty easy. Out of sample testing, you got to do a little more bookkeeping and you know, it's a little tougher. And then Walkforward is the most difficult. And up until a few years ago, a lot of software, TradeStation included, didn't even offer you the capability to analyze it. So you had to use other tools. And as I'll show you later, I use a tool that was around before TradeStation offered Walkforward testing as part of their platform. And that's one reason I stick with it, is because I've used it for so many years. But the point is, when you start getting to these types of analysis, it's a lot more complicated, it's a lot more difficult, and a lot of people drop out and they say, well, I'm not going to bother with that, it's not going to do much for me. So that's the analysis complexity. Believability. Obviously, the most believable is the real-time, real money, right? If your strategy is making money or not, you know, it's hard to beat a real money test, and that should be pretty evident. Optimized testing is on the other end, where I see optimized tests all the time, and I also see what happens when they go to real time and they fall apart. So they're not very believable. Out of sample is believable. Walkforward testing is more believable. So real money testing is obviously the best one, followed by Walkforward testing. Now, how easy is it to develop a strategy? Obviously, like I said, you're not going to spend years and years developing a strategy that is with a method that just gives you one strategy out of 10,000 ideas. Real money testing, that's easy because, like I said, you're not doing any testing. You just start trading. People love that because they want to get that action. You know, there's that gambler's instinct. Avoid that. That's what I'm telling you. Optimized testing is pretty much just about as easy. You can take a whole bunch of rules, optimize them like crazy, and get really nice looking results. Don't mean much, but it'll tell you this strategy has performed marvelously in the past. A lot of people fall for that. Then out of sample's more difficult, and then Walkforward's the hardest of those four methods. It is not easy to pass a Walkforward test and to pass the criteria we use in the strategy factory. But it is. It is possible. It's just not easy. But then again, should it be easy? You know, what makes you think that you should just test an idea and it should work? You know, think about who you're up against with the market. There's a lot of people with a lot of money and a lot of PhDs and statisticians and hedge funds are all fighting against you. So it's not going to be easy. It's not supposed to be easy. So I think Walkforward being difficult kind of makes it more realistic. Okay, I kind of mentioned this earlier, but the amount of out-of-sample data, obviously real-time testing, and if you optimize up until yesterday, you're not going to have any real-time out-of-sample. You're not going to have out-of-sample data until you start running live. You'll have a small amount with the out-of-sample, you know, if you do the 80-20, but you'll have the most with the Walkforward testing, and that's pretty nice. And then finally, what's the tendency for it to work in real time? Obviously, real money is real time, so it works. I mean, that's just a yes. Optimized testing almost never works the way it's been optimized. Out of sample's better, and Walkforward's probably a step beyond that, but those results at least give you a good indication of what's likely to happen in the future. So they're a lot more believable than, say, optimized testing. So that's a comparison of all those four methods, and hopefully you kind of understand why I've selected Walkforward testing as my kind of go-to choice. It is really a great way to test. It's not perfect, but all things considered, it gives you a lot of out-of-sample data and makes for a good evaluation. Well, so let's take an example. I'll walk you through an example of how to do walk-forward testing so you get a feel for it. Because this will be something, it'll be easier with time as you do it. But at first it's pretty tough. Now the nice thing nowadays, most trading platforms will do this walk-forward analysis for you. And there's also third-party tools. As I mentioned, I use something that's called StratOp WFP. It's probably one of the best trading investment education dollars I've ever spent. It's pretty cheap and it works pretty good. So you can do it automatically. The problem with all these automatic, computerized methods is it really doesn't give you a feel for how this works. Because a lot of people will think about it and they'll be like, well, but wait, if I'm testing and I'm optimizing, it's not really out of sample. So this is walk-forward isn't truly out of sample, and they get all confused. So the best way to do this, to understand how it works, is just to run it by hand. Do it manually. So back to that chart I showed earlier, just do those tests manually and record everything manually. And you might say, wow, that's kind of cumbersome. And it is. And I actually used it back when I won the World Cup trading contest. There wasn't this automated software to do walk-forward, so I actually did it by hand. But it gives you a great feel, a tremendous feel for what walk-forward actually is when you do it manually a little bit. So I suggest you do that until you get comfortable with it. Then you can use the software. Then you'll at least understand what it's doing as it does it. And it will also speed it up too, which is important. You don't want to be stuck doing manual walk-forwards because it'll be painful. Okay, so let's just take a simple example. We have a simple momentum system with two inputs to optimize. This is all TradeStation code, but you should be able to follow along no matter what language you use. My inputs are X bar, which are the number of bars back, and you'll see that in a second, and my stop amount, which is just $1,000. So I'm going to vary this X bar value from 5 to 25 in steps of 5, and I'm going to value the stop loss. I'm going to vary the stop loss from $500 to $2,000 in steps of 500. Simple rules. If the close is greater than the close X bars ago, meaning the momentum's going up, we buy the next bar. And if the reverse is true, if the close is less than the close X number of bars ago, we sell short. And then we just put a stop loss with it. Really simple system. Two variables, pretty nice. And actually, if you could get something like this to work, it's great because it's simple and it'll probably tend to work going forward. You'll see that in the actual Strategy Factory workshop, where simplicity is really a guiding principle that I use. I try to make everything simple because the simple things tend to work better than a system with 20 rules and 50 variables. Those don't work as well. Okay, so you have your chart up, you've inserted your strategy, and that's right here. So here you put in your optimization and you hit OK a couple times and it will run for you. And you can see here I'm only doing 2007 to 2012. Okay, so I'm just doing a 5-year period and I'm going to get the best results. Okay, so the best results from 2007 to the end of 2011, the beginning of 2012, it says use 20 for X bar and 1,000 for your stop loss amount. That will give you the best net profit. So now these values I'll actually apply to 2012, which wasn't part of this test because I stopped on January 1st, 2012. And then I go and I test 2008 to 2012, and it says 20 and 1000 again are the best ones. Sometimes they are, sometimes they aren't. So it tells me I should apply that to 2013. And I can keep going through 2009 through 2013, 2010 to 14, 2011 to 15. And I rerun the optimization every single time, and I get the best set of parameters. Okay? And I'm just recording those at this point. I don't know. I haven't run the analysis to see how well it does. But once I do that all manually, then I just create a version of my strategy with the walk forward values. So this is January 1st, 2012 to January 1st, 2013. I use these values. Then in 2013, I use these, 2014, these, and so on all the way through. This is the walk forward version of the strategy. It's the version that is all out of sample. And this is where people get hung up, because they're like, well, wait, I just tested and optimized over 2013, so how can it be out of sample? It's doing it step by step. You're ensuring that that next period is out of sample. So you put it in the code like this, where you have different variables for different time frames. You run it, and you get the results. Now, this doesn't look too good. There's a huge drawdown here, and then it makes money overall, but that's a big drawdown. Compare that to the optimized version, where I took all the data and just optimized it. Well, the optimized has a pretty good drawdown too, but it also has much better profit. It's about 60,000 net profit, where the walk forward version is 30,000. And that's pretty typical, because like I said, the over-optimized, or the optimized version, tends to be overly optimistic. The walk forward is probably closer to what you'd get going forward. So with the walk forward, let's just say you traded this, you might expect it to keep going basically at this slope. But with the optimized, you'd almost never expect it to keep going like that. It just doesn't happen. And that's what I just said. The walk forward are worse than the optimized, but that's actually a good thing. And that's one of the things as you test and you develop strategies with the Strategy Factory, that's one of the things you'll come to realize, is making a better back test isn't necessarily always a good thing. You know, a lot of people think, hey, here's my back test, I should go back and add some filters and this and that. That's not always a good way to go. And in fact, a lot of times it's the wrong thing to do. I can tell you example after example of people who've been working on strategies, making back tests better and better, yet their real-time performance doesn't show it. And it's just for this reason, that optimized results don't always work going forward as well as walk forward, and they usually don't. Okay, so that was just a quick primer into some different test methods, and also gives you a feel for walk forward, how to do it, how it looks, and how it would work manually. As I mentioned, it's much tougher to develop a system with this, but it's more likely to carry on in the future. And once you learn how to do it manually and try it out, then you can get some software to help you to do it quickly. There's still a lot of other pitfalls to walk forward, which I'll talk about in the actual Strategy Factory class, but this hopefully just gives you an intro to walk forward, so you can compare it in your mind to no testing and to optimized testing and to simple out of sample testing, so you can get a feel for how walk forward differs from that. So with that, I'll end today's little session, and you'll see a lot more about walk forward in the actual Strategy Factory workshop. So thanks for listening.